In this video, we'll go over some evidence that more gamblers were born into the stock market, especially since about 2020, and how this could lead to more volatile downturns when things like rate cuts happen. We've done some other videos on some historical trends around rate hiking cycles and rate cutting cycles relative to the stock market, and some fairly volatile swings that could be worse going forward. And here, Mr. Warren Buffett and the late Charlie Munger are essentially talking about how Wall Street makes money no matter what. They get the crumbs off capitalism, according to Mr. Buffett. And Charlie Munger's talking about how it's almost a mania of speculation, how buying producing companies are kind of a thing of the past. It's more of a gambling casino for many folks. So let's take a look at some data to kind of illustrate that and why this could be an issue. So as you can see, we start getting some stimulus money and freedom of time somewhere around this part here, and then starts going up the number of Americans that own stocks. And certainly it's gone up over time. It's gone up a ton since the 1980s, and even before the 80s. It was, for decades, very few people actually owned stocks. And now, in 1989, we can see over here that about 30% of households held stocks directly or indirectly. In 2022, about 58%. And if we look at why would this matter? Well, first of all, if you look down here, since 2019, the stock holdings, median value of households direct stock holdings nearly halved from 2019 to about $15,000 in 2022. What that means is people that own stocks are putting less money into the stocks because they probably have less money to put into the stocks. So in other words, it's inexperienced investors jumping into the market. And so the question becomes, when drawdowns come, if people only have $15,000 to put into the market, what will their staying power be as the stock market starts to decline, 10, 20, 25, 30%? Will they panic? Do they have the staying power, both emotionally and financially, to stay through that, especially if unemployment, if that's a recessionary environment, if unemployment is rising and they're losing jobs, maybe they sell at a steep discount, it makes the situation worse. So this is one reason that the stock market could experience much steeper drawdowns, which is what's illustrated here. Like we did another video, where when the Federal Reserve enters rate reduction cycles after a significant rate hiking cycle, these large drawdowns happen. And if you notice further back here in history, the drawdowns were smaller than they are up here. And you have to wonder if that's because of that data that we were just showing about less experienced investors in the stock market. So this is just 2 pages of a 28-page report where we dive into Wall Street Journal archives from 2007, bond market, yield curves, real estate, supply, demand, where opportunities are, just a ton of information. Happy to send that over to you. Just send an email to 24@code3assets.com. Again, just the number 24@code3assets.com. We'll send it over, and we'll catch you on the next video.